The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. When the dust settled on Tuesday's trading session, we saw the grains do their best. They made a late effort to try and get back at least to unchanged in many of the contracts. We know there is a lot going on that we have to keep our eyes on, a lot influencing this commodity trade here this week. Joining us to discuss, we welcome in our good friend Jim McCormick with agmarket.net. Jim, it's good to catch up with you again, my friend. I hope all is well.
All is well here, Jesse. Thanks for having me on. I appreciate the opportunity.
Well, let's dive in. As I mentioned, we got no shortage of things to talk about in this market trade. Tuesday's session, though, kind of a interesting one. Felt like overnight into the morning, we maybe took some profit. Maybe there was some fund selling or more. We were down double digits. And then by the close on Tuesday, I'll call it firm. I mean, what was your take overall in the grains on the day Tuesday, Jim?
I would argue it's a little bit of profit taken early in the day. I mean, we've had a lot of emotional trade here the last couple of days, Jesse. There's two things I think are driving it. The first one, no doubt about it, is the news coming out of the Black Sea region of the world. It started a week ago when Putin pulled the Russia out of the grain deal, and the market actually kind of yawned at it on Monday. It sold off. And then, what happened is later in the week, Putin kind of ratcheted up the tensions, started bombing the Odessa port, which became a problem. It got the trade's attention. The market kind of surged. But then you might recall, even the latter part of last week, the market kind of backed off a little bit, even though Putin continued to attack Odessa. Well, then over the weekend, they kind of ramped it up again by attacking the, some of those ports along the, Duban River. And the reason why that's become a problem, Jesse, is if you look at where we're at, about half of the grain coming out of the Ukraine was coming out of the Black Sea region. And it seemed like the trade said when he pulled out, they said, "Oh, it'll still get flowing." They took out the essential Odessa ports. So they said, "Well, at least half the grain will still keep coming out because roughly half of the grain comes out of Ukraine via the ports, out of the Dubai, that river system, and the other half is rail." When Putin essentially attacked the river system on that Duban River earlier this week, you've now taken out essentially 75% of the way of getting grain out of the market, and the market surged on that news. And then last night he did not attack the Ukraine. Interesting enough, there were no drone attacks, there were no missiles, and I think it just caused a little bit of profit taking when that didn't happen by some of the world traders. But late in the day, as you said, it firmed back up again because more likely Putin's not done essentially trying to destroy infrastructure in Ukraine. So I think the bears kind of tried to make a quick day trade. Then they took the money and stepped aside to see what happens overnight.
Well, and I know as well, thinking about this Black Sea issue, I saw a headline here early afternoon Tuesday that the European Union's discussing moving Ukrainian grain out, looking to help fund that costly transportation, whether it be, like you mentioned, rail or truck, because that's pretty much what's left with the attacks on those Danube River ports and Odessa and more. It pretty much just leaves rail and a lot of the unknowns there, and it's definitely very costly to do that. So just thinking about basically Ukraine getting shut off here, unless something changes and this grain deal gets restarted, which seems doubtful, this is going to be a volatile market, I have to think, moving forward here the rest of the summer, Jim.
No doubt about it. And just to add a little bit to the volatility is what's going on in India. India right now is trying to fight higher food prices, plain and simple. They're actually talking about importing wheat. That's the last thing we need is India to import wheat if Ukraine can't get the wheat out. But more importantly, they announced earlier this week, Jesse, that they're going to essentially suspend or limit the amount of rice coming out as they're trying to control food costs in front of their next presidential election. And that just makes it that much harder to feed the world and drive the price of food up in the world. And like I said, I think that's going to keep it very volatile. Now, the one thing I'm going to caution people from getting too ragingly bullish about this is, Putin could easily come back in here and cut the deal and say, hey, I'm doing it for the betterment of the world, and try to look like he is the savior, even though he's a narcissist that started the problem. Now he's going to try to solve the problem. The other thing I'm kind of curious about is the Chinese. The Chinese took a lot of that grain from the Ukraine, and if they can't get grain from the Ukraine, they got to compete with other people and other sources from around the world, potentially the U.S., South America. Their prices are going higher. And there are reports that China is now starting to put some pressure on the Russians to try to re-up and get this deal going again. And I got to believe, Jesse, so goes China. If China wants this deal to get re-implemented, Putin will find a way to get it re-implemented. He'll say he's the reason why it got re-implemented. Mm-hmm. But there's a lot of political pressure. So, I mean, if you're a trader out there, I think you got to be a little bit cautious about getting too bold up on this situation. Like we're going to go back to the highs we saw at the beginning of the war. But that being said, though, it's going to be very volatile until we get to a little bit better conclusion of what actually is going to happen in that part of the world.
I'm glad you brought up China, because I think that's an interesting tangent we should talk a little more about here for a second. Is, we've heard the talk, China's been booking cargoes of beans out of South America, and obviously Brazil, Argentina, they have plenty of corn and beans to ship over to China right now, but China likes to get a lot of corn, a lot of wheat from the Ukraine, and not having that, I have to think, little brother Russia is kind of making big brother China a little mad here. So to your point on that, I could definitely see China possibly influence, somehow back channel this grain deal getting restarted, Jim.
Exactly. I mean, I think that's our best hope of getting the deal done. It's probably Turkey's another one. Honestly, Turkey takes a lot of Ukrainian grain. So, Turkey has a vested interest in trying to get a deal done as well, because they need the way to get that wheat to feed their people. So I wouldn't be surprised eventually some kind of a deal eventually comes about. Mm-hmm. Like I said, my guess is Putin's going to spin it as he's saving the world from starving, although he's the one that actually caused the crisis to begin with, interesting enough. But don't be shocked if a deal does happen somewhere down the line, would be my guess. It's just a matter of when, more than likely.
Well, and to your point, not getting too bulled up here and being cautious, but on the flip side of that, taking advantage of and rewarding yourself with the rally here, whether we're talking corn, wheat, soybeans. Obviously, we've moved these markets back higher quite a bit the last few sessions. Have to think this is a good opportunity. You mentioned a little bit of consolidation Tuesday. Have to think this is a good opportunity to protect your risk and try to make some things happen, some sales or lock some floors in. A lot of opportunity here, Jim.
I think you nailed it. Beans are $3 off their low. Corn, we had a heck of a rally in corn in June, only to see it free fall back down. The reality is supply rallies usually aren't very long. They tend to burn bright, burn fast, and die quick. We saw it in June, and we can see it again here in July. And we think, not too often you get a secondary two weather rallies in essence in 1 year, which is kind of what we've got as well. The corn rally here this week essentially did about a 62% retracement of the June high to the July low, just shy of the July 200-day, or excuse me, just shy of the 200-day moving average. So yes, I would encourage producers to, if they feel comfortable about their crop, go ahead and make some cash sales. If they're uncomfortable about it, I would still encourage them to buy puts on both corn and the beans. Weather is still yet to be played out. But the one thing we are very concerned about here at agmarket.net is the demand portion of the balance sheet. The reality is it doesn't matter which product you're looking at, corn or beans. The demand is really, really a problem. On the beans, new crop sales, I think, are the second worst in the last 10 years. The only time it was worse when we were in the midst of that trade war. We're not competitively priced. By some estimates, we're not competitively priced all the way through the fall at this point, depending on when you get to quote. So there's a lot of our contacts that are suggesting the government may be overstating or overestimating bean export sales by as much as 200 million bushels. Now, that could be very bearish if you leave the yield unchanged, because all of a sudden your carryout instead of 300 million is 500 million, and that definitely doesn't describe where bean prices should be. But what it also does potentially for the government, it gives them a little wiggle room. After those crop ratings came out last night, a lot of these yield models people put out are putting the national bean yield right around 49.5, 50, or roughly a 2 bushel drop. So if you lose 2 bushels, you cut demand by 200 million, you're still looking at a very comfortable price of beans, which tells me more than likely the bean price is going to go lower. And the same situation is there for the corn. The corn carryout's 2.2 billion right now. If you lower that corn yield another 3-4 bushels an acre, in essence, you could drop it down to 170, Jesse, 11 off a trend. You leave exports unchanged on the corn side of the situation year on year. Guess what? Your carryout's 2 billion. Your ending stocks to use is around 14%. And historically, when you have 14% stocks to use, you do not have 550 corn. You have corn closer to 450 on the high end. And a lot of times you actually have a 3 in front of the number when it's all said and done. So the overall arch of this theme, I think, of in general, is you got to use this rally to protect profits, because if the crop is there, the prices are going to go down. Now, that is the wild card. I mean, we've had a lot of damage, a lot of heat. We won't know where this crop's at till we get into a harvest. But like I said, without that demand there, I think supply essentially is going to be overwhelm the market, and we will work our way lower, unfortunately.
We're having a conversation today with Jim McCormick from agmarket.net. Jim, one other thought here, thinking about demand as well. A great point you brought up there with the demand picture here. Do you feel like the fundamentals are a little bit better under the soybean market versus the corn market right now, Jim?
If I got to make an argument where the fundamentals are, at least near term, I think it's probably the beans. Okay. Demand is a problem, okay? Yeah. But the demand, I think the government can lower the yield to continue to lower demand and kind of walk that ending stock down. The beans, on the other hand, are made or broken August, as we all know, Jesse. If this heat that we are experienced this week happens to back out early in August and then come raging back, let's say the second, third week of August, and all of a sudden this market's concerned that we are going to lose 2-3 bushels an acre off this crop, the market is going to respond until they're confident that we essentially have, quote unquote, rationed that demand. So what will happen is the market will go higher, we'll ration demand, and then the market, what we'll find out is the carryout is not as bad as we fear. It'll start building back and the prices will start working back down. So the bean market, I think, could be a little bit more potential. The corn, being the fact we're through pollination for the most part, it gets a little bit harder. Now, I know we can lose test weight. That, when you think about it, Jesse, it's very hard to get a test weight driven rally.
Yeah.
It's just, when we get into correlated grain stocks in March or even in June of the next year, when they wait a second, where's the corn? I put the corn in the bin and then less came out because of the light test weight. That doesn't show up for down the line. So I would argue right now the beans probably have the best potential. Wheat could get explosive if they take out, ports. So you got to be careful. Corn will rally on the coattails of those, but in general, I think you got to look to protect profits when you have the opportunity.
I was going to say, I don't think I have ever heard of a test weight driven rally in the corn market. That would be a new one, I think, for all of us. So definitely don't expect something like that to happen. Great thoughts of the grains, Jim. Let's talk livestock a little bit here as well. And I want to touch on the Fed too with you before we wrap it up today. Cattle a bit lower, even with corn rallying back and kind of trading lower, a little seesaw there. It felt like the cattle market still reacting to last Friday's on feed and inventory numbers and being a bit hesitant before it really picks a direction here this week, Jim. That's what it felt like to me.
I think you nailed it. You took the words out of my mouth. We're just, we had a technical reversal on the charts. That's hanging over the market a little bit. We do have the Fed out tomorrow. Is it tomorrow? I believe it's tomorrow.
Yeah, Wednesday. Yep.
So they're going to be out tomorrow. I think that's kept some speculators out. Although there was some positive news. I think consumer confidence report came out today. It says the best in 2 years, which is always good. If consumers feel good about their economic situation, they tend to go out and spend a little bit more on going out to eat and stuff like that. So that was a good positive turn. But we are also in the dog days of summer. It is hot as blazing right now. A lot of 100-degree temps. People don't want to grill out when it's hot like this. So it's just, we are, that's going to limit it. And, we might just be more of a consolidation mode, at least temporarily, for the cattle market.
Well, I think as well, cattle, and this could go over to hogs too, some of that consumer demand. Hogs had a solid day Tuesday, waiting on cold storage numbers, but I think that all kind of goes together. Some of that grilling season demand, we're kind of through the bulk of grilling season, but It's still summer, Jim. I mean, if folks are feeling good about their pocketbook enough to go buy a steak or go buy pork chops, that's definitely a good influence here in this protein sector.
Well, no doubt about it. Like I said, the hog market, we're seeing it. The August hogs are trying to break out. It looks like they technically want to make a run back to the contract high. It's been a heck of a run. The trend is up, and as they say, overall, the trend's your friend on the cattle market. In the big picture, the cattle supply is still going to remain relatively tight. And if you can keep the U.S. economy moving along in a positive aspect, if you can get the world economies to start to get stimulated a little bit, China, we mentioned it before, China is still a big player in, importing meats, both pork and beef. Their economy is struggling. It did not snap out of COVID like some of the other countries did, but they're actually talking more stimulus in China. So it's something we need to keep an eye on. I mean, if China's economy would really start to roar to life, that would be very bullish, not just for the grains, but also for the livestock.
Jim, you brought up the Fed too, and it seems like the trade overall is 100% pricing in. It seems like that we're going to get a 25 basis point rate hike on Wednesday. Would you be surprised if we got something different than that here from the Fed, Jim?
No, I think they've baked it in. I think they're not going to pull any punches. I think it's going to be a quarter point. And then my guess is, Jesse, we're going to pause here. The reality is your rate is now over inflation. That was our group's belief. It was always kind of the goal all along, was to get that over the inflationary number. And I think they've now done it. Like I said, the positive economic situation, jobs, they're not going to get into cutting mode anytime soon, we believe. But maybe we're at a pause rate. And it's a problem. But in reality, Jesse, I don't know how much of a problem it really is in the really broad picture, and the fact that when you're looking at mortgage rates 6.5% to 7%, that was more normal up until the last 10, 15 years. I mean, that is where most people, if you're, in your 40s or higher, most people have mortgages. Their original mortgage was somewhere between 6, 8, 9%. So a 7% mortgage, it's not as cheap as it was, but I think it's one of those situations the economy can handle at this point.
Jim, too, real quick, crude oil feels like a bit of a canary in the coal mine right now. We broke through the 200-day moving average on Monday. We've set some new 3-month highs there. We're back near $80 a barrel. What's your thoughts on this move in crude here so far this week?
Right now, I think it's more, we're moving to the higher end of the band, but we need to keep an eye on it. I mean, if the economy really keeps going and people, are getting more and more convinced, for the last year, Jesse, a lot of people were convinced we're going to have a recession. How was the Fed going to stick the landing, be able to raise interest rates and not put us into recession? And that tune, good, bad, right, wrong, seems to be changing. And I think that's bringing some money back in and saying, hey, maybe this economy is doing okay. Like I said, the consumer confidence good, stock market continues to move up, and that is essentially bringing some money back into the crude oil market. And crude oil, honestly, Jesse, I think that's the canary in the coal mine for everything. So goes crude, so goes the commodity markets. If the crude oil starts to go, it's good for bean oil demand, it's good for biodiesel demand, it's good for ethanol. Those are the kind of things on the macro front you want to keep an eye on. So the higher this crude goes, although no one wants to pay more for gas, the better off it potentially is for the economy as a whole, as just the sign of the economy is working.
Yeah, great thoughts as always, Jim. Before we let you go, anything final you want to mention or reiterate for folks here today?
Well, I'm just going to reiterate. I mean, we had a lot of clients. I personally had a lot of clients, back in June. They were scared to death to sell that rally. It was nerve-wracking. Right now, we're getting a secondary shot. I think you got to be very concerned about demand if you're a producer. And if you have the opportunity to lay off risk, I would encourage you to do it. If you want to do it in the cash market and then use calls to cover it to the upside, or don't use the cash market, consider puts at a minimum, I'm going to encourage you to, like I said, be cautious of the demand and take advantage of profits when you got them.
Jim, I know if folks have questions, they can reach out, give you guys a call, look at all of your great intel and more online, agmarket.net. And I know, too, you guys just announced, I know there's more details coming, but you're heading back to Nashville early next year for your Farming for Profit, Not Price conference. So you guys got a lot of stuff going on, a lot of ways to help people, don't you, Jim?
Exactly. If you're interested in our research, go to agmarket.net. If you want to call any of our brokers here, 844-424-6758. And yes, we are going to have our conference again down in Nashville. I know you were there, and we hope to see you again down there. It is, I believe, February 4th, 5th, the weekend, the Sunday, Monday before Super Bowl Sunday. So mark your calendars.
Perfect timing. Well, with that, we always appreciate the time. Jim McCormick with agmarket.net. Thank you for joining us, my friend. Have a great one. We'll talk to you again soon.
Thank you for having me on. Appreciate it.
That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.